We have 40 minutes for this panel, but I think we're about 3 minutes behind, so we'll try and keep everything flowing. First of all, I just want to say it is extremely nice to be back in person. It's lovely to see everybody who I haven't seen in a long time. Thank you very much to Capital Link, especially Ani, Eleni, and Nicholas, who do this every single year, and it's hard, and we know how much work goes into it, and thank you very much. So anyway, let's just start. This has been an extraordinarily turbulent year. We had a CPI print, so it's an extraordinarily turbulent morning as well, and assets of all kinds have suffered. I think through the first 3 quarters of this year, the traditional 60-40 has underperformed, down about 20%. That is the worst strategy, but for 2 years, both of which during the Depression. So in light of that, I think it isn't surprising that we have a lot of investors that are seeking out alternatives, seeking out to balance risks, and how to incorporate different asset classes into their portfolios. And so it's very timely that we're here to talk about alternatives and real assets and other things beyond the norm of 60-40. We're very lucky to have Jonathan Mondillo, who's head of U.S. fixed income from Aberdeen. We have Barry Nelson, who's a senior advisor in Advent and a partner there, and Brian Cordes, who's senior vice president at Cohen & Steers today. We're going to have some time for Q&A afterwards, so I'd just like to turn the microphone over to Jonathan to get it started, and then we'll do follow-up and Q&A afterwards. And with that, Jonathan.
Yeah, thank you very much. As you stated, I'm head of U.S. fixed income at Aberdeen. A lot of what I do in the alternative investment space is on the public finance and the project finance side. So we deal with issuers both in the municipal space as well in the private lending space to get infrastructure assets built. So mainly long-term lending structures to large infrastructure projects both in the U.S. and outside of the U.S. So I'm going to focus a little bit about what I talk about today on those particular areas. Barry.
Hi, I'm Barry Nelson from Advent Capital. We specialize in convertibles. I loved Alex's introduction about 60-40 not working, because we have long argued that convertibles automatically shift back and forth, that this is an easier way to effectively have diversity of getting equity-like returns with in a fixed income structure. And I've been at this for 50 years. Next month, I may have more seniority than anyone else in the room. None of you appear to be my children. And anyway, convertibles have performed as well as equities over the long term. And they've just had a terrible start to this year, one of the perhaps the worst in record in modern times. And historically, whenever convertibles have tanked sharply, they've made a spectacular recovery afterward. Enough said for the moment.
Okay. Good morning, everyone. My name is Brian Cordes. I head up the Portfolio Specialist Group at Cohen & Steers. And in addition to leading the team, I also have responsibility covering our real estate team and our preferred securities team. And if you look at the closed-end fund lineup at Cohen & Steers, the majority of our offerings are, in fact, in real estate and preferreds. Unfortunately, both being more yield-oriented asset classes, they've felt quite a bit of pain so far this year as well. If you look at the broader preferred market on a year-to-date basis, right now you're down about 17%. If you were to look at the U.S. listed real estate market, you're down about 31% coming into today. That being said, we're starting to see some things. I'm not going to sit up here and tell you pound the table, back up the truck. But I think as painful as it may be, we know from a historical perspective, these are the times when you should start to think about allocating to these spaces in a dollar cost average or drip type mode. And I can expand on those reasons why as we move on.
Yeah, so when we were crafting this panel, there's a lot of sort of divergent threads here and different asset classes and sort of how do you incorporate them. But there is some unity in terms of the risks that people are trying to avoid, right? So most of the questions that we tend to get are about interest rate risk, they're about credit risk. And so I just thought, as an open question to each of the panelists, maybe starting with Jonathan, what is that balance of risks? How do you adjust for credit risk? How do you look at it in this environment? Interest rate risk? How should investors think about these asset classes, especially when it comes to infrastructure finance and things like that, which they may be less familiar with?
Yeah, sure. So I think when we talk about credit risk, just given the balance sheet performance and some of the inflationary measures that have translated into increased revenues for some of the projects that we deal with, I think on a whole, looking at things holistically, things look pretty strong at the moment in terms of fundamentals. That being said, I think that you look at where interest rates have gone, and we look at public finance and project finance. I think on a go-forward basis, there's no doubt about it that it's going to take more money to build large infrastructure projects, right? So weighted average cost of capital has now gone up from where it was last year, just given the 200 to 300 basis points move that we've seen in interest rates. It's costing more money today to get a project built than it did last year. And I think, you look at the CPI print this morning, inflation certainly seems to be sticky. So I think one of the risks that we talk about with investors when they're investing in the space is, that's going to eat into some of the margins of these projects, debt service coverage ratios, et cetera. And for issuers and for people that are trying to build large infrastructure projects, what does that mean for them, right? So not only is the cost of labor going up, the cost of goods is going up, and depending upon how sticky that is really going to dictate on, how much it costs to build these infrastructure assets. So I think that's really where our main concerns are at the moment in terms of building infrastructure in the U.S. right now. Now, I think one of the positives that helps the infrastructure space certainly is really two things. One is the recent legislation that was passed in the infrastructure, IIJA, as well as the Inflation Reduction Act, which is more like the largest green infrastructure bill rather than an Inflation Reduction Act. And I think what that does really is help leverage those capitals, that capital injection to help build infrastructure in the United States. So I think certainly some risks as a result of increase in interest rates and sticky inflation. But certainly as a result of those two legislative measures, certainly a lot of expected opportunity on the horizon in the infrastructure space.
Interesting. Barry, you had alluded to this sort of the self-balancing characteristics of convertibles. How do you think about that in light of risks, credit risks, interest rate risks, and the like?
Well, first off, historically, convertibles are much more sensitive to equities than they are to bonds, especially to treasuries. That interest rate risk with convertibles is minimal. Credit risk is much more significant, the fundamental risk. And we take a credit focus with the convertibles. Our analysts all emphasize cash flow, and we're very careful to stay on the good side of credit. That said, following this swoon in convertibles and everything else, something like 70% of our convertible bonds are now trading at discounts. They have short durations, a little over 2 years on average. These bonds are virtually assured of coming back to par. And if history is any guide and the underlying stocks recover, and one reason we're down so much is heavy tech sensitivity. The hottest went to the coldest. If that bounces, we're going to do very well with convertibles, and I hope to invest in them. We don't have to be as brave as Mariana alluded to just a few minutes ago.
Brian, I would ask you the same. In terms of just balancing the notions of credit risk and interest rate risk, what do you have?
Yeah, so I'd say with preferreds, of course, one of the primary risks is rising interest rates, right? And one of the ways we've gone about defending against that this year is emphasize more, allocate more to the institutional preferred market. And if you're not familiar with that market, essentially the preferred structures in the institutional market are primarily fixed to reset securities, where your coupon's fixed for a designated length of time, typically 5 years, and then if the issuer doesn't call it away, it's going to reset at whatever the 5-year treasury rate is, plus an additional credit spread. So we've been allocating more to the institutional market this year to defend against rates. But in addition, we've also been focusing on those securities that are closer to their reset date. The closer they are to the reset date, the lower the duration. At the same point in time, we've increased the level of quality within the portfolio. We've been focusing in on higher quality issuers, selling off some of our more non-investment grade rated securities. But for preferreds as a whole, the issuers of preferreds are less cyclically oriented. They're primarily banks, insurance companies, and then other regulated industries such as telecom and utility. So maybe not the same cyclicality you would see from issuers in, let's say, the high yield market. Similarly, in the real estate market, one of the things that we'll typically look at is allocating the property types based on lease duration, okay? If you think about some of the property types, those with shorter lease durations, hotels, they can raise the rent on a nightly basis. Forms of residential, apartments, single family for rent, manufactured homes, your lease duration is typically going to be a year, or even self-storage. So those types of landlords, they have the ability to, let's say, offset increases in inflation or rising rates by resetting the rental rate on the tenant sooner, and that can help offset, okay? The challenge has been, though, of course, we're also dealing with a recessionary environment, right? Slowing economic growth. So the playbook isn't necessarily the same as what you would be able to use in prior periods. I'd also point out, some of those property types that tend to be a bit more defensive would be things like healthcare, right? Where it's more needs-based demand. If the economy improves or declines, it's not going to result in that much change of demand. But they do have longer lease durations. They can be upwards of 10 years or more. So with that, they're more interest rate sensitive because they're more bond-like. So you couldn't just necessarily move into a full-blown defensive mode either. So I'd say what we've done right now is we're fairly balanced, but we're focused more on property types that I would call stable growers. Property types where we don't expect demand will be as negatively impacted from a recessionary environment. Not recession-proof, but more recession-resistant. And in that, I would think of data centers, the cell towers, single-family for rent, even industrial self-storage for that matter. Those are kind of some of the areas that we're emphasizing to overcome that today.
Yeah, as a midtown operator, I just came from my company's offices, which are candidly 65, 75% full on a good day and maybe 50% full on a bad day. Yeah. How do you feel about the office space?
It is our largest underweight position across the board. In fact, we are really void of any office holdings up and down the coast. So nothing in New York, LA, San Francisco, Boston, DC, and part of it is what you alluded to, right? If you look at office utilization rates right now in the large coastal markets, you're still at about 50 to 60%. So many of these buildings may be 80 to 85% leased or occupied right now, but what happens when those leases come due, right? What is the likelihood that these tenants are going to be looking to release or re-up for the same space? It's probably pretty unlikely. So in fact, the only area of the country right now where we don't mind office all that much is in the Sun Belt. Because of course we continue to see Americans migrate towards these areas, but corporations are as well. Everyone's looking for lower tax jurisdictions. So we're the company we own primarily focused in Atlanta, Nashville, kind of Tampa, St. Petersburg area of Florida.
Yeah. Brian touched on something important. He used the word granularity, right, to sort of differentiate even within these asset classes or within these areas which parts are interesting and which are not. Barry, do you think sort of anything applies there in convertibles? Are there sectors that are more interesting, or are there broad rules of the road that people should be aware of?
Well, I'd say tech has been with us forever in convertibles. We recently wrote a book in which we went through the history of convertibles, going back to the invention of the steam railways in the early 1800s, extremely disruptive, and it's been that way throughout the nearly 200 years of the modern convertible market. So we always have a tech focus. It's a multi-cap market with convertibles. We even have a few financials. Indeed, AVK owns 2 convertible preferreds issued by banks that have $1,000 par, just like the institutional convertible preferreds Brian referred to, although they are not fixed to floating, they're simply fixed. For your personal accounts, you ought to look at this 6% yield qualified dividend income. So anyway, we're wildly diversified in convertible land. We don't have a lot of companies with real assets, but we have an awful lot of companies with cash flow, and at present, we've got a lot of yield with short maturities.
Yeah, and Jonathan, I would ask you the same question. What are some of the factors that push you towards one subsector or another?
I mean, I'd say less so one sector versus another, but within particular sectors, certainly when we talk about project finance, infrastructure builds, we're looking at issuers or projects where there is some revenue certainty, right? So certainly prefer availability payment projects where the equity sponsor has negotiated, in many instances, a municipal entity, some level of profit margin. So, and in addition to that, have inflation ties to the revenues that they're able to collect from that infrastructure asset versus more volume-driven based infrastructure assets. Volumes in certain particular sectors, one being mass transit, obviously Metropolitan Transit Association being a Metropolitan Transit Authority being the largest in the country, have seen fare box revenue collections drop off considerably, right? So you look at ridership levels today versus pre-COVID, we're still only about 70%. And that sort of translates to other infrastructure, mass transit projects as well. So I think it's important that depending upon the sector and within those sectors to focus on projects that are, as I said, where the revenues are availability based, and there are some levers to increase those revenues as inflation increases or as demand decreases. Again, as we get into sort of an economic slowdown or even a recessionary environment versus those volume-based assets.
Interesting. Barry is the only one yet who has mentioned an actual ticker symbol from his firm and what he thinks some of the advantages are. Would you tell us a little bit about how you actually put the rubber on the road?
Yeah, so we run a number of different open-ended mutual funds. On the closed-end fund side, we've recently launched ASGI, which is a global infrastructure strategy. It's on the private equity and public equity side, so I'm more focused on the debt markets, but certainly think that the portfolio management team in place has been doing this for quite some time. There's a number of different opportunities, I think, to pair those two different asset classes of public equity and private equity within the closed-end fund wrapper, if you will, which I think also translates to the public-private opportunities on the debt side, but that's probably for another discussion. Again, ASGI investing and going to benefit from some of those tailwinds from those large infrastructure projects over the next coming years. Now trading at a rather steep discount, somewhere in the range of 12 to 13%, paying out close to a 10% dividend. So I think there are certainly opportunities not only to capitalize on some of those macro tailwinds that we talked about, different legislative packages, and also just a global focus on infrastructure build, whether that be in core infrastructure or in sort of the greenification of energy distribution and energy generation. So I think that's probably one ticker that we would focus on in terms of opportunity set.
And Brian, how do you feel about that?
Yep, so look, we manage a number of different funds. I think if I just called a couple out, in the preferred market, we have PTA. If you look at that portfolio right now, you've got an indicated yield on it right now of 9%. The duration is just at about 4 years, so you've got a good income per unit of duration there. Currently trading at about a 13% discount to NAV as well. And when you think about preferreds as a whole, they're trading at about 12% discount to their par value. So the securities are trading at a discount, and then the fund's trading at another discount. But perhaps the biggest takeaway with that fund, nearly all or nearly all of the income is going to be treated as qualified dividend income. So you'd be taxed at a top rate of 20% versus 37%. So I got to think a yield of 9%, nearly all treated as QDI at some point, that's got to get pretty attractive to people. Also on the more real estate side, we did have a launch earlier this year, RLTY. That was in February. That one has underperformed, obviously, but I think there too, you're trading at about a 10% discount. That, on the real estate side, is looking to take advantage of a lot of the migration patterns that we're seeing. So you'll see a number of holdings in that strategy that are looking to take advantage of the moves to the south and the Sun Belt. And then Doug, who was up here earlier, Doug Bond from Cohen and Steers, he manages FOF, which is a fund of funds, where he's surveying the entire closed-end fund market and positioning that portfolio with his very best ideas across the entire universe.
Great. And Barry, if there's anything left to say about AVK, which I think there is.
After this gathering, I'm going to offer a drink to Doug Bond to make sure he puts AVK in this portfolio. I liked Brian's reference to discount on discount. Again, most of our bonds are at discounts now, and the fund has slipped to about a 9% discount. And we also we have a lot of leverage. We weren't excessively leveraged, so we still have our leverage intact. We're 45% leveraged. This market bounces. That leverage is going to reverse from a handicap to something very favorable.
Right, and then so that actually, Barry, I just have to follow your lead for all of my questions. My next question was about leverage. And how do you view that? How does the firm view locking in longer costs, longer term financing, just sort of the balance versus trying to go for capital appreciation versus the income considerations? How are portfolio managers dealing with leverage these days?
I mean, it's certainly gotten more expensive than it was last year, to some of the first panel speakers' comments. Most of the leverage in the closed-end fund structure is based off of floating rate preferreds, variable rate demand notes on the municipal side. I think if I was a closed-end fund manager, I'd probably be decreasing my leverage position right now, just given the trajectory of short-term interest rates. That being said, I think more long-term, I think that's one of the benefits of the closed-end fund structure, right, is that you're able to capitalize on the use of leverage. And in particular, one of the things that I had mentioned before, and one of the reasons why I think the closed-end fund structure is good for less liquid or even illiquid assets, is that you're baking in on the debt side some sort of an illiquidity premium, right? So 50 basis points for a private debt structure is generally what we look for on the infrastructure side. That compounds in addition to the ability to use leverage. So despite leverage costs increasing, and I think on the whole, probably managing portfolios to a lower leverage ratio right now, I think more long term, there's certainly significant benefits to the use of leverage in a closed-end fund vehicle.
Yeah. Either of you guys, Barry, Brian, on that subject?
Well, I would just say that we are doing some hedging with AVK, but predicting interest rates, and it's very easy to predict and extremely difficult to get it right. Indeed, My first task as a portfolio manager in 1981 was a bond fund in which we concluded that interest rates were going down. And this view was so unpopular that on opening day, the salespeople insisted on calling me. They wouldn't take the orders from the traders to buy long discount treasuries. And they wouldn't believe me. They called the CEO. And we got the orders executed. And in our first quarter, we came in first place among all open-end mutual funds, fixed income. And that's why I'm here today. When you start out and have beginner's luck, you sometimes have a career.
Yeah, and with Cohen and Steers, I'd say we've always kind of taken a more cautious approach towards leverage, where we look to lock in the floating rate portion via interest rate swaps, where we're paying floating and we're receiving fixed, right? So that really helps to kind of lock up the floating rate portion. I'd say right now the weighted average term of those swaps is still about 4 years, and the cost of the debt right now on average is about 2.5% on our strategies. And if you think about, that's on preferreds, on the preferred portfolios. And if you think about the yield levels you're able to get in the preferred market today, an investment grade index of preferreds is currently yielding over 7%. So, but it's
Yeah.
kind of
Jonathan alluded to liquidity premiums and the closed-end fund structure efficiency at taking advantage of those. Do you see any of that, Brian, in your space, places where portfolio managers can use this structure compared to mutual funds or other things where the liquidity requirements might be greater to gain an advantage?
No, I mean, look, if you look at the funds today, they're all in the preferred market, they're all trading at pretty steep discounts. As I said, PTA's at a 13% discount, the others are at about a 9 or a 10% discount. So at times you'll see them trade at premiums, but you're pretty deep in the discount area right now.
Right. I would like to editorialize for 1 second. I know that this panel is about these guys, but there is also a liquidity premium. When you start talking about PTA or ASGI, these are term trusts trading at double-digit discounts that are going to close these discounts, right? It is that there's not much you can guarantee, or at least are allowed to say in this business, but that's going to happen. A closed-end fund discount is a liquidity premium. If you have to sell a $10 net asset value for $9 to get out today, that money you left on the table is the price of liquidity. And so as people are entertaining these issues and sort of understanding within the disciplines of each individual asset classes where liquidity premiums are, but also within the structure of their investment, you can find that as well. Again, I'm on the analyst panel. At the end of the day, I think it'll be my job to tell you why I think these things are dirt cheap, but we'll get to that afterwards. We have a little bit of time left. We've got about 10 minutes on the clock, so I just wanted to put it to the audience. If there are any questions, we'll take them at this time. Otherwise, we'll keep going.
Hi there, David Adler, XAI. Question is, we talked about different risks. Is there any interest in terms of ESG from investors? Since we're talking about real assets, often that's linked to an ESG solution. Do you offer ESG solutions? Or put it another way, have the risks you've mentioned superseded investor concerns about ESG and it's not driving inflows?
So I could say I haven't seen all that much interest in an ESG kind of closed-end fund. I will say that with most of our investment teams, we are taking into account ESG considerations as a part of our due diligence and valuation framework, right? So in both real estate and preferreds, our investment teams will start with MSCI's ratings as a starting point, and then they're making adjustments to that score based upon their own views and findings through conversations and engagement with company management. So that is being taken into account, not only in our due diligence, but also as we go through the valuation framework as well. But as far as demand for a closed-end fund vehicle, I myself have not experienced that.
I would echo what Brian said. I don't think we hear anything about ESG with our closed-end fund. I mean, our business is mostly institutional, and we certainly are taking ESG seriously for the institutional clients, and we even have a committee working on this.
Yeah, same here. Not so much in the wealth channel. I think when we're having ESG discussions in where we're deploying capital, it's probably more institutional based, and I'd say even more so for investors outside of the U.S. That being said, we do feel that it is certainly a real opportunity for future investment and future returns as we go forward, right? Some of the Paris climate initiatives with 2030 and 2050 zero carbon goals are going to contribute to increased allocation to those types of infrastructure projects. So we do see a good deal of opportunity there. And we also see, on the flip side, a good deal of risk when you're talking about carbon emitting power generation. So coal, mainly coal, but even on the gas side. So I think that it's important to educate some of the wealth community that maybe is less interested right now just about what those risks are, even though they might not care about one particular issue over another. I think those risks are real, and they should be compensated for those risks. So that's how we look at ESG. Those are the conversations that we're trying to have with the wealth community. But to echo some of my fellow speakers' points, it's not something that we're looking to launch in the closed-end fund space.
Okay, anybody else? David.
Participation by retail investors in private equity, private markets is something that might be fertile ground for closed-end funds. The SEC has been a little bit restrictive in putting up limitations. Can you comment about the democratization of private equity investment for retail customers via closed-end funds and whether the SEC is being constructive on this?
Well, I think we've come a long way, right? So our interpretation right now, obviously with the launch of ASGI, is that we can allocate to a 25% in private equity within the closed-end fund structure. I think it's likely that that gets expanded at some point, and I'd be surprised if those discussions aren't ongoing. As I said previously, I think the closed-end fund structure makes a lot of sense for less liquid, I hate using the term illiquid assets, private equity, but certainly private debt being one of them. And I think it's important for a couple different reasons, but the main point being that we've got large need for real assets, infrastructure build. On the green energy front, it's somewhere in excess of 150 trillion over the next 30 years. That's roughly the size of the entire global capital markets and the equity market, that is. So where are the investors right now in private debt in particular? They're in the institutional channel. What is it going to take to get these infrastructure assets built? The wealth channel, the retail channel, globally, not just within the United States. So I think it's a necessity that we find ways to invest in these less liquid assets. And it makes a lot of sense in the closed-end fund structure.
Brian or Barry, anything on that?
Well, I'd say that this sounds a bit like tech to me, that efforts to enhance the environment are going to involve new technologies, growth companies, the kind of companies that tend to issue convertibles.
Yeah, and I think you may see us look to invest in some private within our real estate offerings as well, because if you look at the real estate market right now, for example, the public market's down 32% year to date. You talk to a lot of advisors who are invested in the non-traded REITs right now, and they're going to tell you that a lot of these firms have marked up the asset values of private real estate. And that's not all that surprising because public typically leads by 6 to 12 months, right? So I'd say kind of get ready for those potential markdowns. But there's always that opportunity to arbitrage between the two, right? And I think that's a capability that we may look build upon more in the future.
Does anybody else have a question from the audience? If not, I have one more. It's interesting that we've gotten through an entire closed-end fund panel and we have yet to talk about the income issue. What do you think in terms of distributions, clients who buy these for income, people who want some certainty as to their income? What should they be expecting in the next 6 months, the next year, or as far as you feel comfortable saying the ICs? I'll give Jonathan the worst question first.
I anticipate no changes to our distributions. No, it's serious. I mean, look, in the preferred world, yields are going higher, right? To give you a sense, at the end of last year, issuers were coming to market with coupons in the high 3s to low 4s. Bank of America, a high-quality U.S. issuer, obviously, issued back in May at 6 1/8. That's trading at a discount. So I think a high-quality U.S. issuer right now would have to come to market with at least a 7% coupon attached to it. And that's just in the U.S. You look overseas and you look at the contingent capital market, you're looking low double-digit type coupons right now. So I think yields are going up, income levels are going higher from here, but no anticipated changes to our funds.
AVK has a record of maintaining stability with our distributions, with only a couple of exceptions in our history, and that seems likely to continue in the future. All we need is a significant total return, and with discount convertibles, with everything down so far, and with the leverage that we have, I think it's a good bet that we're going to have good total returns looking ahead, yet we were able to maintain the monthly distribution during this recent, dare I say, market collapse.
Jonathan, we've got 45 seconds left, and we'll leave you on the hot seat.
Yeah, I'd say it's probably natural that as short-term interest rates push up, as the first panel said, that it's going to eat into your distribution yield. I think it's our hope probably that things have leveled off, and one of the benefits, especially on the debt side, is that as those securities mature, you're able to now reinvest at yields upwards of 10%, if not more, depending upon the asset class, depending upon the credit risk. But it's just a matter of, do short-term interest rates continue on this trek upward? Obviously, I alluded to the CPI print this morning. It looks as though it will. But again, my hope is that where we've seen dividend cuts, we've probably seen the worst of it. I would hope.
All right. Well, anyway, on that note, thank you very much, everybody, for coming, and we'll take questions after. Bullseye.